Hello and welcome to another market update. Hope everyone is having a solid week. As usual, we're going to kick things off with a summary of the stories I'll be getting into today. Starting with last week, we had US Q3 GDP numbers come out, which beat expectations at 2.6%. Then the latest ISM manufacturing numbers came out, which signaled the slowest growth since 2020. And we all know what happened that year. And then U.S. job openings unexpectedly rose by over 400,000.
Say what?
Then the ECB raised its interest rates by 75 basis points.
Whoa.
Japan spent a record amount on its YENTERVENTION.
For real? You fuck with that?
There are rumors of China reopening and easing its COVID restrictions.
Right.
Biden threatened oil companies to lower their gas prices.
Come on, man.
And Tether fires back at Bloomberg misinformation.
Little bitch.
But before I get into all that, let's go over a quick recap of last week. So last week, U.S. 30-year fixed mortgage rates broke 7% ahead of the next Fed meeting.
Not crazy.
Which is later today. New home sales in the U.S. took a dive, but beat expectations.
Nice.
Google and other big tech names fell significantly after disappointing earnings.
And we say bye-bye.
The Bank of Japan's FX intervention failed to fully rein in the yen. Newly elected UK Prime Minister Rishi Sunak pledged to lead Britain out of economic crisis.
Totally.
Saudi Aramco said the global energy transition is flawed.
You're a fucking idiot.
And Bitcoin miners have been under serious pressure from the increasing difficulty adjustment. All right, with that out of the way, let's go ahead and get into our first story. So first up, we got U.S. GDP numbers. So the U.S. economy grew an annualized 2.6% on quarter. I don't know why they say on quarter, but in quarter in Q3 2022, beating forecasts of a 2.4% rise and rebounding from a contraction in the first half of the year. So for those who don't know, or maybe you do know, we had two negative quarters previously. So in the Q1, it was minus 1.6% GDP. In Q2, minus 0.6%, which by, a lot of people talking about, like, is that the real definition? And technical definition, or whatever you want to call it, that is technically what a recession is. Either way, we had 2.6% positive GDP this quarter. Definitely not saying we're out of the woods yet. Obviously could have a negative print in the following quarters. If anything, that's my base case, most likely. But anyway, 2.6%, surprise to the upside. Woo! Which is somewhat positive news or negative news, because maybe it means Powell is going to be more aggressive in his hiking and just overall policy. But anyway, I digress. So the biggest positive contribution came from net trade, which is a little surprising, as the trade gap for the U.S. narrowed. Imports sank 6.9%, while exports were up 14.4%.
Nice.
Which was led by petroleum products, non-automotive capital goods, and financial services. The petroleum products I found interesting because the United States is literally selling oil from the SPR, so you could think of them selling their strategic oil to help supply, in part, petroleum products that they're exporting. So releasing the SPR to, in some sense, at least partially, supply the rest of the world with petroleum or oil-related products.
You're a fucking idiot.
And at the same time, non-residential investment jumped 3.7%, boosted by increases in equipment and intellectual property. On the other hand, residential investment sank for the sixth quarter, down 26.4%. As the housing market has been hit by soaring mortgage rates, which, as I mentioned in the beginning, reached over 7%. And I think right now they are over 7% again because they retraced a little bit, which is pretty remarkable. 7% is just wildly higher than what they were just a year ago, at like 3%. And finally, consumer spending grew at a slower pace, 1.4% versus 2%, but remained resilient as higher outlays on services, led by healthcare, offset a decrease in goods, namely motor vehicles and food and beverages. Also, the drag from private inventories was smaller. Now, one thing I thought was interesting about this is, I guess most specifically the trade aspect of it, because the dollar has been appreciating pretty dramatically. So if the dollar is more expensive, exports are going to be less competitive because on a relative basis, things in the US are more expensive. So someone in Europe, China, Japan, wherever, they are trying to buy things that we're selling, which are denominated in dollars. Those are more expensive relative, to the currency they're holding, euro, yuan, yen, respectively. So that is very surprising that, I guess it says, exports were up 14.4% versus 13.8% the previous month. So the fact that they're rising still while the dollar itself is rising, I found was very interesting. Could be, as I said, largely driven by petroleum products, just because the world, needs oil. So interesting. Either way, 2.6% positive GDP for the third quarter. All right, let's transition to our next story. So the ISM manufacturing, and actually before I get into this, I pretty much mention this every time I talk about the ISM, but for anyone who doesn't know, the ISM manufacturing PMI index is a good metric, or one of the most trusted metrics for measuring overall economic growth and contraction. And if it's above 50, it's a sign that growth is increasing or expanding. If it's below 50, it's decreasing, contracting, which would be, like recessionary. So if you see this chart, before I actually get into this, you can see that the ISM index has been on a steady decline for basically the last year, and this is the lowest print of all of them to, obviously not ever, but, within the last year, since 2020, right? I think I mentioned that. And it's almost in recessionary territory because we're at, 50.2. So anything below 50 is technically contractionary, recessionary, whatever you want to call it. You can pretty much interchange those words.
Totally.
So the ISM manufacturing PMI fell to 50.2 in October from 50.9 in September. Not a huge drop, month over month, but still the rate of change. The rate of change isn't necessarily what to focus on, even though in a lot of cases it is. Just note that we are on a steady decline, right? This is a lower print than the previous month. And, if the next one is below 50, that's obviously not a good sign in terms of economic growth. So figures came slightly higher than market forecast of 50. New orders contracted less, 49.2 versus 47.1, and employment was little changed, 50 versus 48.7, while backlogs of orders went down, 45.3 versus 50.9. Companies are continuing to manage headcounts through hiring freezes. We've heard a lot of companies halting any hiring, and even in, I think, Amazon, they halted hiring in their the web services, AWS, which is obviously like the most successful aspect of their business. So them freezing hiring there is not a good sign because, one of the most successful aspects of one of the most successful businesses is no longer hiring. What does that say for all the other companies? Companies are continuing to manage headcount through hiring freezes and attrition to lower levels, with medium and long-term demand still uncertain. Meanwhile, price pressures continued to ease for a seventh straight month and fell into contraction territory, 46.6 versus 51.7, which should encourage buyers. Also, production rose faster, 52.3 versus 50.6, with panelists reporting softening new order rates over the previous 5 months. The October index reading reflects companies preparing for potential future lower demand. So if the economy is contracting, there's going to be less demand overall. And like I said in the beginning, this is just a good metric for measuring the overall growth and growth, expansion, or the opposite, recession, contraction of the overall economy, at least for the U.S.
My man.
All right, moving on. Let's transition to job openings. So the number of vacancies in the United States unexpectedly rose by 437,000 to 10.72 million.
Damn!
In September, up from 10.2 million in August and easily beating market expectations of 10 million. The level of openings remained close to a record high at the end of 2021, which could add to inflationary pressure coming from raising wages to attract and keep staff. So let me dissect that a little bit. If you have more job openings, that means the employers are basically competing for workers because there aren't enough workers to fill the position. So to attract workers, they would raise wages. But if there are fewer job openings, then you have workers competing more for the jobs, which would put downward pressure on prices. It's kind of like supply and demand, right? Everything boils down to supply and demand. If you have an over of supply of workers relative to job openings, then price will have to adjust. In this case, the price being wages, will have to adjust to the downside. So this is one of the things that Jerome Powell and the Fed are actually looking at very closely. They want to see job openings decline. That way workers have to, in essence, compete more for jobs, which would put downward pressure on wages and accordingly downward pressure on inflation. At least that's the intention in what Powell and the Fed are looking for. So that's one of the reasons I wanted to bring this up. But anyway, so where was I? So openings were up in several industries, with the largest increases being reported in accommodation and food services, plus 215,000. So it's a pretty sizable amount of that 437,000. And then healthcare and social assistance, plus 115,000. And transportation, warehousing, and utilities, up 111,000. Meanwhile, job openings decreased in wholesale trade, minus 104,000, and in finance and insurance, minus 83,000. Elsewhere, the number of hires was down by 252,000 to 6.33 million, while total separations, including quits, layoffs, and discharges, and other separations, declined by 370,000 to 5.6 million. Now, if you look at this chart, we have seen not necessarily a consistent trend with job openings, especially after this latest number, because we had a pretty small print the previous month, totaling of 10 million or 10.28 million. So definitely going the wrong direction, because as I said, the Fed and Jerome Powell, they want this number to be going down because they want wages to be going down and help ease some of the pressure on inflation. So these going the opposite direction, month over month, a pretty sizable increase. And that's not good for the Fed, or at least that's not what they're aiming for.
Yep.
All right, let's transition to our next story. So last week, the ECB raised its key interest rates by 75 basis points during its October meeting, following a similar move in September and bringing borrowing costs to the highest since early 2009 as it battles its high inflation and a looming recession. The decision came in line with forecasts, no surprise there. The refinancing rate now stands at 2%, the deposit facility rate at 1.5%, and the marginal lending rate at 2.25%, if you care about that. So the central bank also expects, this is key, to raise interest rates further and will base future increases on the evolving inflation and economy on a meeting by meeting approach. So not really changing their tune in the sense that they are taking the data-driven approach, meeting by meeting, day by day, whatever you want to call it. But they are being very clear that they are open to increasing rates further.
Not crazy.
Which, might be, they need to kind of do that to be serious about inflation, but they're not exactly, their economy, the European economy as a whole, just because there's so many moving parts with different countries that have different needs, debt levels, etc. They aren't exactly well equipped to weather sizable rate increases, so that's definitely problematic. But nevertheless, they're still remaining pretty hawkish in saying that they are, because this is a 75 basis point hike. That's a pretty big move for the ECB and really any central bank these days. But they are expecting to raise rates further. Now, we'll have to wait and see if they want to continue with 75 basis points, 50 basis points, 25. I doubt they would drop down to 25 right away. They would probably go to 50 first and then maybe 25. But either way, pretty sizable increase to their interest rates. And they are very clear that they are considering or very open to continuing this hawkish stance with further rate increases.
My man.
All right, next story. Let's keep the ball rolling. So Japan spent a record $42.8 billion in October interventions to prop up the yen. That was a big deal. The yen is, for those who've been following the FX or currency markets, the yen has been depreciating pretty aggressively, especially against the dollar. It got to USD JPY got to like 150, a little bit above 150, and then the Bank of Japan really essentially intervened, and right here, with a record amount of 42.8 billion, because they are trying to manage that currency and or manage the currency depreciation. They don't want it to get out of hand. I don't think they're necessarily that opposed to it depreciating slowly, just because they know what they signed up for by maintaining their low rates, pending their interest rates through yield curve control. And it's only a matter of time before as long as the Fed and other central banks are remaining hawkish, it's only a matter of time before that really starts like creeping up on them and getting to a bad level. But they're more concerned with the volatility or excessive increases. So they'll probably keep intervening as long as there is this pressure. But if there is a faster, like a rate of change, a faster depreciation in the yen, I'm sure we'll see more sizable interventions with them selling their treasury balance to defend the yen.
Totally.
Anyway, let's get to this article. So Japan spent a record 42.8 billion on currency intervention in October to prop up the yen, according to the finance ministry, with investors keen for clues about how much more the authorities might step in to soften the yen's sharp fall. So they have a sizable balance of treasuries, which is basically just like a dollar-denominated asset they can sell to then buy yen. So if they sell the dollars and buy yen, that puts pressure kind of on both sides for USD JPY to help defend their currency. And they have, I think they go back and forth, a really close amount to what China has, but basically they have like $1 trillion worth of treasuries they can use to defend the yen. So it's not like they don't have a lot of ammunition. They don't have unlimited ammunition, but they do have a decent amount. So at the very least, they can continue this intervention for some time. I don't know what level of treasuries they're comfortable with selling, but they do have a lot. So the 6.3499 trillion yen, or $42.8 billion, was broadly in line with the estimates of Tokyo money market brokers, who thought Japan had likely spent up to 6.4 trillion yen over 2 consecutive trading days of unannounced interventions. That's the key part. They're being very discreet about it. They're not announcing things. They're just kind of intervening when they see fit. And I believe oftentimes that's strategically, or they strategically intervene, as in they try to intervene at times when there's like thinner liquidity so they can move the market a little bit more. So if there's less buyers and sellers in the market because of the time of day or whatever it is, that's when they're looking, it seems, to be intervening. You can use that information however you see fit, but just a point to keep in mind that they are, I guess it makes sense. They're trying to be strategic about it. They want whatever money they spend to go as far as it can. So the amount was nearly double the 2.8 trillion yen Tokyo spent last month in its first yen buying and dollar selling intervention in more than 2 decades. And the last time they intervened was basically when the dollar yen pair got to around the same level, like 146, I believe. And that was around when their first intervention was. So this second intervention was after the yen got to like 150, 151 against the dollar. So the latest intervention records were registered from September 29th to October 27th. Monday's figures will draw additional scrutiny after the finance ministry refrained from commenting on its apparent actions in the market this month, taking a stealth approach, like I mentioned, to intervention. It confirmed last month's yen buying actions immediately after it occurred. So indeed, Japan's top currency diplomat, Masato Kanda, hope I get that right, he said there was no limit to the authorities' resources for conducting intervention. Now, technically, there is a limit because they only have so many dollars or treasuries they can sell. But I suppose you could read this as he's saying there's no limit to their resolve. They're willing to defend it to whatever extent they can. So we'll see what that ends up looking like. If they do start selling a lot of treasuries to defend the yen, that is going to add more pressure on U.S. yields because they're selling treasuries. Yields rise. So that is something to maybe consider. But either way, pretty interesting development to follow going forward.
Totally.
All right, let's transition to China. Whoops. So this is an interesting story. Just full disclosure, completely unfounded so far. I believe, and I'll get into it, like Chinese officials have denied it. Now, they'll deny a lot of things even when they're happening. But either way, people are starting to whisper about this because it's a big deal. China is the second largest economy, the manufacturing base of the world, and so they dramatically influence, like their economic standing dramatically influences the overall global economy. So if they are basically turning on and off the, economic switch, so to speak, that is going to have serious implications for the market. So a lot of people are starting to watch this and really figure out if and when the Chinese government economy is going to shift gears and fully reopen, kind of let go of its COVID zero policy.
You're a fucking idiot.
So Hong Kong and China stocks jumped on Tuesday after rumors based on an unverified note circulating on social media that China was planning a reopening from strict COVID curbs in March triggered a sharp rebound following last month's savage selling. I'm gonna have to use that term. I like that. Savage selling. Woo! A Chinese foreign ministry spokesman later said he was unaware of the situation. An unverified note trending in social media and tweeted by influential economist Hao Hong, hope I got that, said a reopening committee has been formed by Politburo standing member Wang Huning, and Jesus, these names are so hard. I'm too white for this. And is reviewing overseas COVID data to assess various reopening scenarios aiming to relax COVID rules in March 2023. This is a quote, "I don't know where you got this information. I truly don't know anything about this." And it's Foreign Ministry spokesman Zhao Lijian who said when asked about this committee that people are speculating on. So obviously, definitely take this with a grain of salt because there is no guarantee that this is happening. You literally have Chinese officials denying it, but they'll deny a lot of things that are completely true. Either way, it's something to keep on your radar because when China reopens, if and when it reopens, I guess, that'll be a big deal for demand for commodities, for imports, exports globally. So definitely keep an eye on this story.
Yep.
All right, let's keep it going with Mr. Joe Biddy. So Joe Biden get the hell out of here, Scott.
And we say bye-bye.
All right, so Joe Biden this last week has basically been threatening oil companies for their soaring record profits amid these crazy gas prices that are obviously impacting people's view towards him, the administration, the party in power, which is very relevant given we have midterm elections in the U.S. coming up. What is today? November 2nd. So yeah, in a couple days. So it's a big deal. Now a lot of people are saying this is like peacocking. He's just trying to act like he's gonna scapegoat. Not that these energy companies aren't making a lot of money, but people didn't really give any. They didn't give big tech companies like Apple, Microsoft, or whoever else in the market any problem when they have record profits. It's just because this is relevant to his ratings and midterm elections.
Totally.
But let me just get into this. So President Joe Biden threatened Monday to pursue higher taxes on oil company profits if industry giants do not work to cut gas prices. Their profits are a windfall of war, Biden said, referring to Russia's war with Ukraine, which prompted Western sanctions that reduced oil supply. It's time for these companies to stop their war profiteering. Interesting rhetoric that he's choosing. So if they don't, they're going to pay a higher tax on their excess profits. With 8 days to go before Election Day, obviously this is the key thing to keep in mind, the context or the subtext, White House messaging has focused on how Democrats are working to improve the economy and how Republicans would make it worse. Inflation and the economy consistently rank as the top issue for voters, and higher gas prices stretch consumer budgets for much of this year. So, like I said, this is undoubtedly part of him just trying to appease his voter base, act like he is doing something to tackle inflation and high gas prices, while also shifting the blame. At least he's trying to shift the blame away from him and saying it's not his policies or his fault. It is these companies reaping in crazy profits that are price gouging people with high gas prices. Now, obviously, look, there is probably some kernel of truth to that in so far as companies could lower their profit margins or whatever, but realistically this has to do with just this energy shortage and the supply issues with oil and all this stuff. So it's not like it's necessarily entirely in their hands. Either way, I wouldn't be surprised if this kind of rhetoric from Joe Biden really tapers off post-election, because then he doesn't necessarily care. He'll just do what he wants to do because there is no vote on the table that could jeopardize his power or this party's power.
Right.
All right, so any new taxes on oil profits would need congressional approval. This is another part that would signal that this is kind of just, feigning interest or just like this political game, political chess move, because it requires, it's not like he can just wave his magic wand and have this implemented. It has to go through Congress. And I don't think Congress is going to reconvene until after the midterm elections. And as it stands right now, it looks like Republicans are going to take control, most likely, of Congress. So there really isn't, and I guess just historically speaking, Republicans aren't usually the type to tax big corporations just straight up. So it's unlikely that this will actually happen. But anyway, so any new taxes on oil profits would need congressional approval, which may prove difficult as Democrats control both chambers of Congress by slim margins. Progressives like Senator Bernie Sanders and Elizabeth Warren previously floated the idea. Obviously, of course they did. So earlier this month, Biden announced the release of 15 million barrels of crude oil from the Strategic Petroleum Reserve. I heard a funny reference today, or funny, renaming of that. It's the Strategic Midterm Reserve for election purposes. So the White House has released about 165 million barrels of crude from the reserve since the beginning of the year. And that has been, they've been like one of the biggest sellers in the market. So they have been, I guess you could say, somewhat artificially holding down the oil market, oil prices, by selling millions, 165 million barrels of crude onto the market. It was like $1 million a day.
Not crazy.
Out of a total of 180 million. So they originally committed to 180 million. They're at 165. So they're planning to release the last bit of that right before midterm elections. I mean, the timing of this is so it's laughable, because they're literally planning to release the last little bit of the 180 million right around midterm elections. Like, what are the odds that the 180 million you set out to release ends right before midterm elections? It's just, I don't know, it's pretty transparent, but hopefully people make those connections. All right, last bit of this story. Biden promised in his earlier speech to purchase oil to refill the reserve once the price hits $70 a barrel. He said companies should therefore invest now and increase production with the confidence that the government will purchase the oil later. This was very fascinating to me, that the U.S. government is essentially putting a floor on the price of oil, because they're saying they're going to be a buyer if it hits $70 a barrel. So if it ever gets to 70 or below, you can kind of rest assured that they're going to have a huge buyer into the market to keep price at that level or push it higher. And he's literally telling companies that they are going to buy oil from them at $70 if it gets there. Now, I don't know if oil is going to actually go at $70. Obviously, there's going to be, with this information out there, potentially a lot of people front running that $70 price. And even with that, though, it doesn't necessarily get down to $70. I mean, the oil market, the spot oil market, that is very tight right now. So it's not a guarantee that oil will even get down to 80. I wouldn't be surprised if it did. But either way, this is, I just wanted to include that last little bit because I thought it was interesting that the U.S. government is essentially putting a floor on the price of oil, saying they're going to refill the Strategic Petroleum Reserve, which makes sense because they've drained it so much that, it's strategic, right? So if you don't have your oil for your Strategic Petroleum Reserve, you are somehow strategically disadvantaged, right? Because if that's what the SPR is for, and you don't have your oil in the SPR, there's some sort of strategic disadvantage you have. So there is a definite interest in refilling that at some point. And after this draining is complete of the 180 million, they are going to start filling that up at some point. And everybody in the oil market pretty much knows this. So when is the U.S. going to buy? Because that's a huge buy. They're going to be buying millions and millions of barrels to refill the SPR. And that will have a serious impact on oil prices, right? Again, potentially putting a floor at $70.
Not crazy.
All right, let's transition to our final story. This is our crypto story. So we got basically Bloomberg taking a swing at Tether and Tether firing back. So Tether is asserting that Bloomberg is misinforming the public about USDT. According to information provided on a live broadcast on Monday afternoon and a published article earlier in the day, Bloomberg reported that the U.S. Department of Justice, the DOJ, was reorganizing investigations into potential bank fraud claims against Tether. At this time, no one should be surprised by the reports circulating about the DOJ and Tether for almost 5 years. The stablecoin settlement, nevertheless, characterizes the Bloomberg news as wholly incorrect rather than merely denying it. Tether posted an official rebuttal on its website, calling it desperate for attention and recycling old material that isn't even real.
Little bitch.
Critics point to the problem like Tether's employee to circulating supply ratio. It only employs a small number of people but has over $60 billion in USDT in circulation. I don't know if I really understand that. I don't think, I mean, maybe that makes sense. I'd have to look more into it, but I don't really know how employees have a direct correlation or relation to the amount of USDT in circulation. Either way, it doesn't really matter. So Tether continued by claiming that as part of their commitment to cooperation, openness, and accountability, they regularly communicate openly with law enforcement organizations, including the U.S. Department of Justice. It is unfortunate, as Tether saying this, it is unfortunate that purportedly trustworthy media outlets like Bloomberg have trouble comprehending a technological advancement transforming the globe. Now that part I thought was a little stupid because the technology is separate and apart from them maybe, being fraudulent or having not having the assets to back USDT. USDT can be a transformative technology and you can still have or not have enough collateral to back the USDT. So I thought that was kind of stupid, little inflammatory response. And final bit, regardless of complaints and publication rumors, Tether remains adamant that it will lead the stablecoin market through the upcoming wave of adoption.
Right.
Now, this Tether FUD stuff has been around almost as long as Tether has been around. And nothing has happened to date. That's not saying that they are perfect or that nothing will happen, but USDT is so connected to the crypto market. Especially in, on a global scale, like in the Western world, the US specifically, USDC is, ostensibly become the stablecoin of choice. But outside of the US and like Asia, USDT is sometimes the only stablecoin that is available. Like all these platforms, exchanges, whatever, they are basically entirely based on USDT. They only have USDT pairs. Everything is USDT settled. So if USDT Tether blew up and had some problem, that would be unbelievably catastrophic for the industry. I mean, I can't imagine how many exchanges would go insolvent, or it'd be a remarkably terrible occurrence. I mean, I really can't even fathom how crazy it would be, but yeah, so anyway, I don't know if it's going to be a problem, but if it is, it's going to be a huge problem. So take it all with a grain of salt. But anyway, that is all the stories I have for you today. But before I get out of here, let's go over the week ahead, what to keep your eye on. So later today, as I mentioned earlier, the Fed will be delivering its interest rate decision, which is, that's the biggest central bank to watch, and their policy kind of guides the world at this point. So definitely want to watch that. The expectation is a 75 basis point hike, bringing the Fed funds rate to 3.75 to 4%. And then we have the EA unemployment numbers coming out on Thursday. The previous month was 6.6%, and the forecast is an increase to 6.7%.
Whoa.
Nothing too crazy. Then also on Thursday, we have the Bank of England delivering its interest rate decision. The current rate is 2.25%, and the forecast is a 75 basis point hike to 3%. Now, if you recall, after the whole gilt thing, they half did QE, so there's quasi involved in QE to at least help provide liquidity and backstop the pension funds that were struggling with their collateral issues. But they're also raising rates at an aggressive rate, 75 basis points. Now, there's more talk in the Bank of England about easing, just because they are, I guess, and sometimes coming to terms with okay, we'll take higher inflation if it means we don't go through a crazy, just wildly terrible recession that everybody is mostly predicting. So I don't know if we'll see the Bank of England really continue this aggressive pace going forward. As I alluded to earlier, a lot of them are kind of basing this off of the Fed, because if the Fed raises rates and they don't, then you have their currencies just getting a lot of pressure. They're going to be, going down relative to the dollar, which is problematic. So they are trying to keep pace with the Fed, but they are not exactly in the best situation or as good of a situation as the Fed, the Fed being the cleanest dirty shirt. So we'll see if that continues. Anyway, prediction or forecast is 75 basis points. And then also on Thursday, we have ISM non-manufacturing PMI comes out for the U.S., I believe. The previous month was 56.7, and the forecast is a drop to 54.5. It's a sizable drop, but still not in recession territory, but still the direction matters. And then on Friday, finally, we have U.S. unemployment numbers coming out. Non-farm payrolls are expected to decrease to 240,000, and unemployment is expected to stay flat at 3.5%.
Nice.
Now, that isn't necessarily a good thing from the perspective of the Fed, because they want unemployment to go up to, I think, like 4.5%, 5%. So staying flat is definitely not what they're trying to do. But either way, I guess good for you because you're not losing your job, right?
Yep.
All right. Well, that is really all I have for you today. But as always, stay happy, humble, and most importantly, solvent.
And we say bye-bye.